The war for money, how power hides behind the markets. 11. Gold and silver drains. For centuries, gold was the adult in the monetary room. Then came paper, promises, and PowerPoint presentations. Now, the metal is quietly fleeing the vaults of London like party guests who've realized the host can't pay the bill. Every ounce leaving Western exchanges ends up somewhere less talkative, mainly in Asia. The same story for silver. What does that actually mean? It means confidence is migrating east. You don't need to read balance sheets to see it, you can weigh it. While governments brag about inflation targets, private hands are hoarding tangible money. History has a sense of humor, it always sides with whoever keeps the gold when the music stops. Footnote. Physical metal outflows from Western vaults mark a silent global vote against fiat stability and institutional trust. 12. Digital dollar mechanics. The phrase digital dollar sounds innovative, like an app that makes capitalism more fun. In practice, it's surveillance with a slick interface. Central banks say it's about efficiency, technocrats say it's about safety. Translation, it's about control. Programmable currency means money that obeys policy. It can vanish after a deadline, reject certain purchases, or deny service for your protection. So what does that actually mean? It means your bank account becomes a behavioral report card. The irony? The same system sold as progress could recreate the feudal contract, only this time, the landlord is an algorithm. Footnote. Digital currencies replace neutral money with programmable compliance tools that extend administrative reach into private life. 13. Plumbing the dollar. Beneath every currency lies plumbing, pipes that move credit, interest, and panic. When the pipes clog, politicians call it a liquidity crisis. Everyone else just calls it broke. Modern treasury operations now resemble emergency surgery on a patient that refuses to stop eating. Debt is the bloodstream, and the transfusion never ends. So what does that actually mean? It means stability has become a performance art, half monetary policy, half improv. Every fix adds another valve, another rule, another acronym. The system grows safer on paper and shakier in practice. Footnote. The modern dollar system survives through constant intervention that masks insolvency beneath technical jargon. 14. The 30-year miracle. Before government-backed mortgages, home loans lasted about as long as a presidential term. Then someone invented the 30-year note, a slow-motion wealth engine for the middle class. It worked beautifully until 2008, when the magicians behind the curtain collapsed their own stage. The crisis didn't just pop a housing bubble, it rewrote the social contract. So what does that actually mean? It means homeownership became a managed privilege instead of an attainable goal. Fannie Mae and Freddie Mac, once safety nets, turned into leverage points. The dream stayed alive only on paper, and even that paper was securitized, sliced, and sold. Footnote. The government-sponsored mortgage transformed private housing into a regulated asset class vulnerable to systemic manipulation. 15. The mortgage machine reloaded. After the crash, reformers promised transparency. Instead, they delivered thicker fog. New rules locked out first-time buyers while institutional investors bought entire neighborhoods in cash. Banks still claim they serve the community, but the community can't afford the down payment. The entire system now feels like a rigged carnival game, you can play, but you can't win. So what does that actually mean? It means the path to middle-class stability runs through gates owned by global funds. The genius of modern finance isn't in innovation, it's in making dependency look respectable. Footnote. Post-crisis regulation consolidated homeownership under corporate landlords, redefining security as tenancy with paperwork.